Something is rotten in the state of semiconductors. The air is thick with uncertainty, and the ground beneath these tech titans is starting to tremble. It's a situation that demands a closer look, a deeper understanding of the forces at play. The giants of the industry, TSMC, the world's leading semiconductor manufacturer, ASML, the Dutch company without whom nobody can make advanced chips, and AMD, are reeling. These powerhouses, once seemingly invincible, are now facing headwinds unlike anything they've seen in decades. These companies are the backbone of the digital world, the very foundation upon which our modern lives are built. From smartphones to supercomputers, their chips power everything. Yet their stock charts are awash in red, a sea of losses, reflecting a deep unease among investors. The market is sending a clear signal. Something is fundamentally wrong. The cause? Not poor earnings, not a sudden drop in demand for their products, but a geopolitical earthquake, the escalating US-China tech war, a conflict that's redrawing the lines of global power and reshaping the future of technology. The once seamless global supply chain, a marvel of efficiency and interconnectedness. Design in America, the birthplace of innovation, manufacturing in Taiwan, the undisputed king of chip production, assembly in China, is unraveling. The threads that held it together are snapping one by one. Washington's crackdown on tech exports to China, a strategic move to curb Beijing's technological ambitions, has triggered a wave of sanctions and export controls, creating a complex web of restrictions that businesses must navigate, shaking the entire ecosystem. The tremors are being felt across the globe, impacting every player in the semiconductor industry. Investors are scrambling to price in a future, a new reality where the old rules no longer apply, where borders and politics matter more than ever. Geopolitics is now a key factor in investment decisions. Headlines of new U.S. restrictions on China have become routine, a constant drumbeat of escalating tensions, each one eroding market confidence. The uncertainty is palpable, and investors are growing increasingly wary. This isn't a blip. It's not a temporary downturn that will soon correct itself. It's a fundamental reshaping of the global tech landscape, a tectonic shift that will have lasting consequences, with the stock market as the first casualty. The market is simply reflecting the profound changes that are underway. Companies are forced to walk a tightrope, navigating treacherous terrain with no easy answers. Between Washington and Beijing, every move fraught with risk. A misstep could have devastating consequences. The great chip stock plunge is about more than numbers. It's not just about profits and losses. It's about the end of an era for the tech industry. An era of globalization and unfettered growth is coming to a close. Let's delve into the stark reality revealed by the numbers. We're about to witness a significant downturn, a trend that demands our immediate attention. The data paints a clear picture of decline, and it's crucial to understand the magnitude of what we're seeing. ASML, once a market darling, a beacon of innovation and growth in the semiconductor industry, has lost over $130 billion in value in under a year. This isn't a mere correction. It's a staggering loss that reflects deep-seated concerns within the market. The speed and scale of this decline are truly alarming, almost entirely due to political turmoil. The impact of geopolitical tensions on the tech sector is now undeniable, with political decisions directly influencing market valuations. The pain is sector-wide. The Philadelphia Semiconductor Index, a key indicator of the industry's health, has tumbled, reflecting a broad downturn across the board, erasing billions in a single session after each new restriction. The market reacts swiftly and severely to any perceived escalation in political tensions or trade barriers. TSMC, despite strong business fundamentals and soaring chip demand, fueled by the ever-increasing need for advanced computing power, has seen its stock drop 35% since January. This significant drop highlights the vulnerability of even the strongest companies to external political pressures. The disconnect between business performance and stock price is glaring, creating a perplexing situation for investors and analysts alike. Investors are pricing in overwhelming external risk. The market is no longer solely driven by traditional financial metrics. It's heavily influenced by geopolitical uncertainties. This isn't a short-term dip. It's not a temporary fluctuation that can be easily dismissed. It's a brutal, sustained bear market for a sector once seen as invincible. The long-term implications of this downturn are significant and far-reaching. A tweet from Washington or a statement from Beijing, seemingly innocuous on the surface, can erase billions in value instantly. The market's sensitivity to political news is at an all-time high. The charts are a scorecard in the US-China tech war, a visual representation of the ongoing battle for technological supremacy, and shareholders are paying the price. They are bearing the brunt of the market volatility and geopolitical risks. The era of frictionless global tech commerce is over. The seamless flow of technology and goods across borders is now facing significant headwinds. The fallout is just beginning. We are only scratching the surface of the potential long-term consequences. Investors are left to navigate a market where logic has been replaced by fear, where traditional analysis is often overshadowed by anxieties surrounding political developments. The numbers don't lie, the risk is real, and the stakes are higher than ever. It's a challenging environment demanding careful consideration and a deep understanding of the forces at play. In the escalating tech rivalry, the United States has wielded a powerful weapon, the export ban. These bans are not just simple trade restrictions, they're strategic maneuvers designed to cripple specific sectors and limit access to crucial technologies. The primary target of these bans is China, with the aim of cutting it off from critical semiconductor technology and slowing down its technological advancement. This strategy seeks to deny China access to the building blocks necessary for modern electronics and computing. The US is targeting key choke points, such as electronic design automation, EDA software, which is essential for designing advanced chips. These tools are the foundation upon which all modern semiconductors are built. By restricting access to EDA software, the US is effectively halting Chinese chip design at the blueprint stage, preventing them from creating cutting-edge processors and memory chips. This is a critical bottleneck in the semiconductor manufacturing process. American dominance in EDA tools means Chinese firms are left scrambling to find alternatives or develop their own solutions, a process that could take years and require massive investment. This creates a significant disadvantage for Chinese companies in the global market. ASML, a Dutch company and the world's leading supplier of lithography systems, is also caught in the crossfire of this tech war. Even though ASML is based in the Netherlands, its machines rely heavily on US-sourced components, making them subject to US export controls. This dependence puts ASML in a difficult position, forcing it to comply with US regulations. Consequently, the US has blocked ASML from selling its most advanced EUV, extreme ultraviolet lithography machines to China, the very machines needed to produce the most advanced chips. This restriction is capping China's growth in the semiconductor market, preventing it from achieving self-sufficiency in chip production and hindering its ability to compete with global leaders. The restrictions are tightening further. Now, even maintenance and spare parts for older machines are under threat, creating further challenges for Chinese manufacturers. This puts billions of dollars of investment in Chinese semiconductor infrastructure at risk, potentially rendering existing facilities obsolete and undermining future expansion plans. The constant escalation of these export controls creates profound uncertainty for suppliers, investors, and the entire global semiconductor industry. Companies are struggling to navigate the complex web of regulations and anticipate future restrictions. The question is no longer simply what can be sold to China under current regulations. The real question looming over the industry is, what new restrictions will Washington impose tomorrow, and how will they further disrupt the global supply chain? The global supply chain is already in chaos, and with the constant threat of new export bans, the future of the semiconductor industry is anything but certain. Beijing is pushing back, threatening ASML with permanent exclusion from the Chinese market if it complies with US export curbs. The latest flashpoint, the Dutch government, under US pressure, may block ASML from servicing even older DUV machines in China. Without maintenance and spare parts, China's multi-billion-dollar investment in DUV equipment could become worthless. Beijing's ultimatum is clear: help strangle China's industry now, and there's no coming back later. ASML and the Dutch government are caught between US demands and China's threats. Losing the Chinese market for DUV machines would be a devastating blow for ASML. The stakes are existential, not just for ASML, but for the global tech landscape. This is no longer a commercial dispute, it's a high-stakes geopolitical standoff. The outcome will shape the future of the semiconductor industry. The Trump administration's semiconductor policy was a volatile mix of protectionism and strategic exemptions. The US pressured global firms to invest domestically, leading to TSMC's high-profile Arizona fab announcement. In Taiwan, this sparked fears of losing its silicon shield, the strategic value of its chip industry. Ironically, while waging a trade war, the US shielded semiconductors from the harshest tariffs. TSMC, despite being based in Taiwan, was exempt from crippling tariffs, highlighting the industry's unique importance. Chipmakers were left to navigate a landscape of both pressure and protection. Under US pressure, TSMC committed to building a cutting-edge fab in Arizona, a strategic pivot from its Taiwan base. The project has faced delays, soaring costs, and labor shortages, far from the efficiency of Taiwan. Instead of stability, TSMC's US move has deepened its entanglement in the US-China conflict. Its stock has dropped 35% since last year, reflecting geopolitical risk, not business weakness. The Arizona plant does little to ease fears over Taiwan's vulnerability. TSMC's American gamble has yet to pay off, leaving it caught between costly expansion and market anxiety. US restrictions and China's threats are fracturing the global tech supply chain. Companies like Samsung and TSMC, reliant on both US tech and Chinese markets, are forced to pick sides. The result? A scramble to diversify manufacturing, moving production out of China to places like the US, Europe, India, and Vietnam. This shift is expensive and disruptive, requiring new facilities, workforces, and supplier networks. The seamless flow of goods is being replaced by firewalls and regional blocks. The risk of two incompatible tech ecosystems, one US aligned, one China aligned, is rising. For investors, this means more uncertainty and higher costs. The stability that fueled the tech boom is gone. The new supply chain is fragmented, costly, and unpredictable. The global tech order is being rewritten in real time. Relentless negative headlines have created a perfect storm of fear, driving investors out of chip stocks. The core issue is uncertainty, political risk that's impossible to model. ASML's $130 billion value loss isn't about innovation, but about shrinking markets due to politics. Every new restriction forces investors to downgrade future revenue expectations. For TSMC, the existential risk of a Chinese invasion haunts investors, overshadowing record profits. The smart money is hedging against low-probability, high-impact events. The old belief that commerce trumps politics is dead. Now, tech companies are on the front lines of great power competition. Volatility and fear have replaced stability and growth. Until a new equilibrium emerges, the jitters will remain. For tech investors, the old playbooks are obsolete. Success now requires tracking geopolitics as closely as earnings. Watch US-China relations. Any sign of de-escalation could send stocks soaring, while new restrictions will trigger sell-offs. Monitor allied responses and supply chain diversification efforts from TSMC, Samsung, and Intel. China's progress in domestic chip-making could shift the balance, but it's still years behind. The sector will remain volatile, with valuations carrying a geopolitical discount. These companies are now geopolitical assets, not just growth stocks. For investors, opportunity comes with risk, and a need to understand that the fate of chip stocks is now in the hands of world leaders, not just CEOs.